So imagine a tax system that puts more money in your pocket, reduces what businesses pay, and even redefines how America trades with the world. It sounds too ambitious, right? Well, buckle up. In this video, I'm going to be breaking down Trump's 2025 tax plan and what you could expect for this upcoming year. And I'm going to be breaking down step by step some of the things of what happened in the past and where we're currently at right now, and also be giving you some practical examples and some explanations as it relates to this. So to be able to understand the potential impact of Trump's 2025 tax plan, it's important to revisit the Tax Cuts and Jobs Act, also known as TCJA, or also known as TICJA, of 2017, all right, which significantly restructured how Americans pay. And it's probably one of the biggest tax changes in the past 30 years. So what did the Tax Cuts and Jobs Act do? So what it did was it impacted standard deduction. So simplifying taxes, the reason they say they were able to do that is they actually doubled and increased the standard deduction amounts. And prior to the Tax Cuts and Jobs Act, it was 6,350 for single filers and 12,700 for married filing jointly. And what they ended up doing was they ended up doubling that amount to 12,000 for individuals, 24,000 for married couples, and they continue to do that to this day. And it continues to increase. Right now, it's currently close to 15,000 for individuals due to inflation. So that was one of the big impacts of the Tax Cuts and Jobs Act. So why was this important? So by being able to raise the standard deduction for this, the Tax Cuts and Jobs Act simplified tax filing for millions of Americans, eliminating the need to be able to itemize deductions, and which was a more complex process, right? So before the Tax Cuts and Jobs Act, to give you an example, if you were a single filer with $40,000 of income and you're itemizing 8,000, you would benefit from itemizing. But after the Tax Cuts and Jobs Act, the larger standard deduction meant you could skip the hassle of itemizing and still be able to reduce your taxable income by 12,000 at the time. And like I said, they continue to increase it. Another big change as it relates to this was a child tax credit. So it allowed families with children to be able to be supported, and it was able to offset some of the rising costs of children. So the Tax Cuts and Jobs Act actually increased the credit from 1,000 per child to 2,000 and made 1,400 of that amount refundable, meaning that families could receive part of the credit even if they didn't owe any money on federal taxes. So why is that important? So for families, this change provided much more relief, especially for lower income individuals. An additional bonus as it relates to this is that Tax Cuts and Jobs Act also introduced a $500 credit for other dependents like elderly parents or college age children, expanding its benefits. So to give you an example of this, let's say a family with two children, they could reduce their taxable income by up to 4,000 annually under the new rules, compared to just 2,000 before the Tax Cuts and Jobs Act. So that continues to increase, and they've been able to maintain that as well. Also, the top tax rate. So they were able to go ahead and reduce that for high income earners. So top tax rate, which applied to the highest tax income bracket, was reduced from 39.6% to 37%. So this was part of the Tax Cuts Jobs Act effort to lower taxes across the board for people in that higher income bracket. And that is important. Why? Because while it only primarily benefited wealthy individuals, it was actually part of a broader change to the tax brackets that provided some relief for middle income earners as well. So let's say in this example, a taxpayer earning 600,000 annually saved about 15,600 in federal taxes under the Tax Cuts and Jobs Act, thanks to the lower tax rate. So those were some big changes, and those changes are still here till this day. Some other changes that are part of this Tax Cuts and Jobs Act was the alternative minimum tax amount. So the threshold was raised, which allowed people who were basically had to pay the alternative minimum tax. It was raised so they didn't have to pay as much state and local tax, also known as SALT, the deduction cap. There was a new deduction for 10,000 on deductions for state and local taxes was introduced to offset the cost of other tax cuts. Estate taxes were also impacted of this as well. And a lot of these changes were designed to be able to be sunset and basically be eliminated in 2025. So here we are now in 2025, and they're supposed to go back to the pre-2018 rules unless Congress acts now. So obviously now with Trump in office, a lot of these are probably going to be expanded or extended longer. So to give you uh some more examples of what that means for 2025. So Trump plans to be able to extend these provisions permanently if possible, and he's going to continue as he promises, or he's proposing that he's going to continue to provide tax relief for families, individuals, and businesses. But it doesn't stop there, right? So one of the big things that they're looking to do is also provide and do more tariffs. All right. So that's going to be something that we're going to talk more about and how that can impact you. He's talking about doing an external revenue service as well instead of the IRS. He's looking to do the ERS, which is a whole different topic in and of itself, which I'm going to do a deep dive on. But essentially, the idea is to be able to reduce taxes for Americans, expand credits, and also alter deductions. And a lot of these, again, may sound beneficial, but a lot of people are really questioning whether this practically can happen and whether this can actually happen. So let's take a deep dive and talk about some of the things that are looking to be changed for this year, right? So number one, as it relates to individuals here, we have the state and local tax, which is also known as SALT. That's going to be, the cap is going to be removed. So the state and local tax SALT deductions will let taxpayers reduce their taxable income by deducting property taxes and either state income taxes or state sales tax from their federal bills. So before 2018, there was no limit on how much you can deduct, but the Tax Cuts and Jobs Act was introduced. They put a $10,000 cap on it, and that impacted people, especially people who are living in high tax states like California, New York, New Jersey. This cap significantly limited their ability to reduce their taxable income, which was not that great, right? So by removing this cap, taxpayers in high tax areas would benefit substantially, right? So high income earners who tended to pay more in property tax and state taxes will see some large savings. So to give you an example of how this works, so let's say a family is paying $25,000 in combined state and local taxes, that can save them up to $15,000 more annually on their federal tax bill if the cap is lifted. So also, he's proposing that he's going to eliminate taxes on Social Security benefits. So Social Security provides income for retirees to millions of Americans, as you all know. So funded generally by the payroll taxes during their working years. So currently retirees who earn additional income from investments, pensions, or part-time work may have to pay federal taxes of up to 85% of their Social Security benefit if their income exceeds a certain amount of threshold. So 25,000 for single filers, 32 for married filing jointly. And why does this matter? So these taxes reduce the monthly income of retirees who rely on Social Security. So for example, a retiree receiving $20,000 in Social Security benefits and $15,000 from a part-time job might pay taxes on a large portion of their benefits. So the Trump proposal is saying that he's going to eliminate these taxes entirely, leaving more money for retirees to be able to take home in their income. So, for example, let's say a retiree is paying $2,000 annually into Social Security taxes. They could keep that money instead of having to go ahead and pay taxes on it, and that could be able to cover a month or two of groceries, medical expenses, leisure activities as well. So many of you are probably wondering, okay, this sounds great, but what's the catch? So while these changes offer some really positive benefits, there is some downsides to it, right? So how to be able to actually fund this. So it's going to impact the government's revenue, of course. So by removing the SALT cap, state and local taxes, and eliminating Social Security taxes, it would reduce how much money the government is receiving, right, for federal revenue, the IRS. So experts estimate that these measures could add trillions of dollars to the national debt over the next decade. So the people who are going to benefit from this is obviously high income earners and retirees, but people who are in lower income households, which typically pay little to no federal tax, might not experience much benefit from these changes. So ultimately, these proposals could help a lot of people, but it will also raise questions as how long can this be sustainable? So as it relates to business owners, right? So there's a couple of changes as it relates to business owners. So business owners, uh, the tax plan that Trump is proposing here could be a really big game changer for you. As you all know, Trump tends to favor business owners and investors. The tax code historically favors entrepreneurs and business owners. So here's a couple of things that they're looking to do. So number one, they're looking to extend the qualified business income deduction. So qualified business income deduction, this was introduced by the Tax Cuts and Jobs Act and allowed business owners to be able to deduct 20% of their profits before calculating taxes. So this deduction applies to pass-through businesses where companies were reporting their owner's personal tax return instead of being taxed at the corporate level. So examples of this will be a sole proprietorship, S corporations, LLCs as well, were all impacted by this. So the qualified business income deduction was a really big business deduction for business owners, and it was able to lower their overall tax liability. However, this is actually set to expire this year, leaving many business owners uncertain whether they're going to continue doing this. But again, Trump is proposing that he's going to extend this deduction as well to be able to allow small business owners to be able to benefit from this deduction as well. All right. So that is the qualified business income deduction. That's the update on that. Also, one new thing here is he's going to be introducing a new corporate tax rate of 15%, which is going to be huge for domestic production. So essentially, this proposal is going to target domestic manufacturers, businesses that produce goods within the US. Currently, the corporate tax rate is a flat 21%, but Trump's plan introduces a reduced tax rate of 15% for companies engaged in domestic manufacturing. So why does this matter? So this lower tax rate is designed to be able to incentivize businesses to produce goods in the US rather than outsourcing them to other countries. And by keeping manufacturing local, the policy aims to create more jobs here in the United States. It will boost local economies and strengthen the US industrial sector, is the idea behind this. All right. So let's say, for instance, a manufacturing company is earning $500,000 in taxable income. That can save them $30,000 annually under the proposed 15% versus the 21%. All right. So some potential benefits of this change could be, again, more companies producing here, more competitive prices on goods produced in the United States, increased investment in manufacturing, infrastructure, technology, greater job opportunities for people in the United States. So that is that, right? So the big thing, a lot of comments and concerns and questions is about the tariffs. Okay, so the tariffs is a new topic, a hot topic. And with Trump's plan, he proposes that he's going to fund a lot of these tax cuts that he's doing that I mentioned earlier before. He's looking to be able to fund them through tariffs. All right. So tariffs are going to be taxes that are put on imported goods. So any goods that are brought from another country to the United States, they're going to have a tax on it. So that's what a tariff is. So for example, if a company imports steel from China, they have to pay a tariff, increasing the total cost of the steel. So there's a couple of tariffs that he's looking to implement here. He's going to have a universal tariff of 10 to 20% on all imports. He's also going to have a specific tariff of up to 25% on goods from Mexico and Canada. He's going to have additional tariffs on Chinese imports. So building on the 300 billion already taxed during his first term. And why is he looking to use tariffs? So tariffs, he believes, can generate a significant amount of revenue, which Trump plans to be able to channel into funding tax cuts and infrastructure projects. Additionally, being able to encourage companies to be able to source goods domestically. So obviously, it does not come with some challenges. A lot of people are questioning whether this is viable, whether this can actually happen. So let's talk about some of the challenges as it relates to being able to have these tariffs, right? So while the idea of tariffs might sound good for producing and promoting domestic production, it's not without drawbacks. So number one, there's going to be higher costs of imported goods. So businesses that rely heavily on imported materials or products could see their costs increase. For example, let's say a company is importing $1 million worth of goods, might face $200,000 in additional costs with that 20% tariff. There's also risk of retaliation. So other companies like Mexico, Canada, China, right, which is putting a huge tariff on, they're going to may try to retaliate, making it harder for America to be able to do business and compete internationally. There's also going to be some potential impact on inflation. So tariffs can actually increase consumer prices as businesses pass on higher costs onto their customers. So let's say, for instance, a furniture manufacturer is importing $500 worth of wood from Canada. They might see an additional cost of 125,000 if there is a 25% tariff that is placed on these companies, right? So to be able to maintain their profitability over the year. So really we have to just balance out the pros and cons as it relates to this. So on one hand, there's people who are supporting this because they're saying that the tax proposals could significantly be able to benefit businesses that operate domestically, especially manufacturers. But on the other hand, just heavily relying on tariffs to be able to fund these tax cuts introduces some economic risk, right? So it can include higher costs for imports, potential trade wars, and strain international relationships. So the bottom line is this, right? For businesses that produce and source materials locally, these changes could provide a significant financial boost. However, companies heavily relying on imports will need to carefully assess how tariffs might impact their operations and profitability in the long term, right? So let's talk about this ERS, external revenue service here. So let's go ahead and talk more about this. So like I mentioned, Trump has proposed creating this new agency to be able to collect revenue from the tariffs. So I want you to think about it as like a counterpart to the IRS, Internal Revenue Service, but instead of handling income taxes, the ERS is going to focus on taxes on foreign goods, right? So currently the tariffs are managed by the Customs and Border Protection, also known as CBP, under the Department of Homeland Security. So Trump, his idea is to be able to shift that responsibility to the IRS, which with importers paying directly to them. So here's a couple of types of tariffs. Like as I mentioned, there's going to do there. He's going to have the universal tariff, the neighbor tariff on companies, or sorry, countries that neighbor the United States, the China specific tariff that he's looking to do as well. And like I said, there's a ton of risks as it relates to this. So again, a lot of people are wondering whether this is possible. So to be able to do this quickly, Trump is proposing that he's going to use what's called an International Emergency Economic Powers Act. So IEEPA. So it's a law that allows the president to manage imports during a national emergency. And although this method has never been used on tariffs before, it could give Trump the authority to be able to act without Congress. And that is really how it's going to be done. So here's the catch with this. All right. So higher tariffs could mean it could actually shrink the economy. So with experts, they're actually believing that 1.3% reduction in GDP over time if tariffs are fully implemented. So again, it's going to be a big deal here. So let me simplify this for the average middle class family here. So as it relates to the changes here, the biggest one that middle class families have to be concerned about is going to be that state and local tax cap, which is going to be removed. So many middle class families could see a big tax savings from that. Homeowners in high income states, like I mentioned, California, New York, New Jersey, would especially be able to benefit from this. These gains may be impacted though, because now there's going to be possibly higher prices on imported goods due to the tariffs increasing. So that's going to be one thing. As it relates to seniors, as I mentioned, some of the seniors can benefit from some of these changes because, like I said, Trump is proposing to be able to eliminate taxes on Social Security, which could be a huge benefit for seniors as well. And it can improve their quality of life, which is a benefit we've already just had recently that was signed into Congress, the Social Security Fairness Act, which is going to be another benefit to be able to benefit public workers, and it can improve the quality of life. As it relates to businesses, like I said, some of the big changes that you need to be aware of is that domestic manufacturers may experience an increase under the new corporate tax rate. Again, having a lower tax rate from 21% to 15% is going to be a positive thing for those manufacturers, because now it's going to be able to encourage them to invest more in their business, create more jobs, and potentially grow manufacturing businesses in the United States. All right. But again, in order to do this, it's really going to be heavily dependent on these tariffs that he's looking to do. And as relates to the average person, there's going to be a lot of opportunities, a lot of changes, I'm sure, a lot of back and forth here. So you just really want to make sure that you're staying up to date as it relates to the impact on taxes. One of the biggest expenses that we have as it relates to our spending is taxes. So you want to be able to look out and stay up to date to this. I'm going to provide as many updates as I can as it relates to this. and as it relates to some of these Tax Cuts and Jobs Act updates and extensions. So you just want to make sure that you go ahead and subscribe and go ahead and stay focused and locked in on this. And also, what, love it or hate it, these 2025 tax plan changes has the potential to really reshape our economy. So let me know what you think. It could possibly be a good thing, bad thing. There's going to be some risks. There's going to be some challenges. There could be some positive benefits as well, but we'll see. And like I said, I'm going to keep you all up to date as it relates to this, but make sure you stay informed, and I'll see you all in the next one. Take care.